Hey everybody. So today I'm pretty excited because this is one of my favorite indicators. And it's a little complicated, the Ichimoku cloud. But once you understand it, it can really yield very good results as far as high probability trades. So I wanted to spend some time going over it. Now today we're going to go through a very basic understanding of it. We're going to talk about what it is. We're going to talk about the parts of it. We're going to talk about how those parts are calculated. I'm going to give two simple signals and then how to determine the strength of those signals. And I want to show how to combine it with another indicator. But it's important to have a general grasp of this. And the one thing that I'm always looking for in my trading is I'm always looking for an edge, right? I'm always looking for inches. So how can I do better? And the one thing that I find is that using leading indicators versus using lagging indicators is one of those things. And this is one of the few leading indicators that's actually out there. So let's just jump right into it. And I think understanding the background of this is a little important. So the Ichimoku cloud, it's a technical analysis method. This was created in Japan. It was created by a gentleman that was a journalist called Goichi Husada. And he started, I believe, in like the late 60s. And essentially what he did was look for a way to determine where support and resistance lines were, as well as trend, direction, and momentum, okay? And he did this by utilizing, which was the format in Japan, which was candlesticks. So what we're looking to do by using this cloud and the amount of data points with candlesticks, this should increase the accuracy and probability of your trades in forecasting price movement. That's the purpose of it. Okay, so I do think it's important to just grasp the concept. He spent 30 years perfecting this. So 30 years perfecting this before even releasing it. So if you think about an economic cycle being 3.5 years, this has gone through at least 6 economic cycles, at least. So just keep that in perspective as we get into it. But let's just jump into the parts of it. So in regards to how I see this playing out, we're going to walk through the 5 major parts. And then by understanding those parts and how they're calculated, we'll get a better grasp of what this is actually telling us. So the first we're going to go over is this yellow line. The first part of this yellow line is called Tenkan Sen, or conversion line. Okay. The second one we're going to go over is this purple line right here, the Kaiju Sen, or baseline. Next is this green line called the Chiku span, or lagging span. Here we have the Senku span A, or leading span A. Senku span B and leading span B. Okay, so I think it's important to understand what these are telling us. This is a lagging indicator. These are leading indicators. Okay, now let's just talk for a moment about how they're calculated. All right, so to start, the conversion line is calculated through a 9-day high-low divided by 2. The purple line is calculated by 26 days high-low divided by 2. The green line is the close of the last 26 days. Now, one thing you'll note about this is how it ends right here. And why does it end here? Because it's 26 days behind. So it ends here, hence lagging indicator. The Senku span A is a leading span A, correct? So we understand that. Now, stay with me. This is a combination of 2 other indicators or parts that are on this page. Okay, so it is a mixture of the Kunjun Sen, or baseline, plus the Tenkan Sen, or conversion line. Okay, they are added together, divided by 2, and then you add 26 days to it. Hence, how we can see how it extends out. The red line, Senkun span B, leading span B, is 52 days, high-low, divided by 2. Add 26 days to it, and you can see how that comes out as well. Now that we have a basic understanding of what they are and how they are calculated, we're going to get into how you can determine not only the strength, but just 2 indicators and 2 that you can use. And there's several more here, but we're going to go through 2 today that you can use to determine your trading strategy. And I just want to stress this. This is one of the most comprehensive technical analysis indicators out there, period. It's very important to understand that and give yourself a little bit of time to learn this. This is not an easy one. It's not just like looking at a moving average, I guess is the best way to explain it. So let's just focus on one simple trading strategy, and we can see how that is being utilized. So let's go back a little bit here on this chart. And what I want to point out very simply is when your conversion line crosses up through your baseline, it is a trade signal. So as we can see here, when the conversion line crosses your baseline, it is giving you a signal. That is a buy signal, okay? I'll say it again. So when the conversion line crosses the baseline, it's a buy signal, all right? Now, when you see I'll give you an example right here, the conversion line cross your baseline, okay, that is a sell signal. So if you look at this chart and understand this just a little bit, and you can go through these movements and how they transpired from here, and then what that would lead to, right, until you cross back over. And of course, nothing's perfect, right? We all know that. But you can see these right here, how you crossed here. And let's just zoom in on that one and just focus on it for a moment. So you can see the cross here. You can see the cross here. These are all signals. These are buy and sell signals. Now, they're not the be-all, end-all, but it's a signal that you need to pay attention to. And it's also a short to medium-term signal. It is not a long-term signal. So I think it's important to understand that this is a short or medium-term signal. It is not a long-term signal. So with that said, let's focus on what is a long-term signal. Well, that in and of itself is going to be the cloud, which is right here. So the cloud should be viewed in a couple different ways. And let's just expand this out just a little bit so we can get a couple more really good examples of what we're seeing here. So what we're looking for in regards to the cloud is this. If you are above the cloud, you are in a bullish cycle, and your trade should be heavily leaning towards buys. If you are below the cloud, that is a bearish signal. And when you see that bearish signal, you should be on the short side or selling. If you are in the middle, which is rare but can happen, you need to let it sort itself out because you are trendless, and let it determine what it's going to do. And that's a great way to combine these two and utilize them, like here, to utilize those two signals to determine what's going to happen. You can see here very cleanly where we were in the cloud, and our first signal that we got was a buy signal from the conversion line crossing the baseline. So that is the longer term signal. Now, to determine the strength of that signal, the wider the gap of the cloud the stronger the signal. So the wider the gap, the stronger the signal. So in response to that, you can see here clearly how the signal was very shallow and then got wider and wider, and how we stayed above. And then when we broke, how wide it got and stayed down. Now, during this period of time, there was no signal. None. Now you have your short or medium term signal execute right here. On top of that, you then have us getting above the cloud right here. So getting above that cloud was your long-term signal. So your short-term signal or medium-term signal fed into your long-term signal, which gave you confirmation. And then you could see how the trade progressed from there. So there are two trading strategies that you could use with this. Now, I want to make this abundantly clear. Not everything is going to be perfect, but this is one of the most comprehensive technical analysis indicators you can use. It is, in my estimation, probably one of the top 3 that you should really be looking at. And there's a lot to it, especially in the way that it's calculated and especially in the way that it is a leading indicator. It also allows you to determine something that another indicator that I like to use. It lets you determine the strength of a move, which essentially is allowing you to determine the magnitude of the move. And you can see how that played out here, 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 and how it was narrow, how we didn't have as much of a move, and then when it gets wider, how that works. Okay, so again, there are several trading strategies based upon this. What I am simply pointing out are 2 very easy ones to start with. In the future, I'm going to do more advanced ones of this indicator, but we need a baseline like anything else to start. So you're going to want to subscribe to the channel and click notifications, because we're going to keep getting into this in depth, and you'll start seeing how to make this even have a higher degree of probability with longer term signals. So we've now gone through how we calculate it, what the parts are, 2 signals that you can use, okay? And those signals are important. Okay? It's very important to understand bullish and bearish and where you are long term in a chart. But again, they're not be all end all. So what I like to do is use another indicator with this, and I like to use the RSI. Now, as everyone knows or may not know, and there'll be a video at the end of this on RSI, RSI determines the magnitude of the move. So if you can utilize RSI with this, then you're going to be able to spot times where you're going to have a possible false signal. And one of those times was right here. As we can see, the RSI gave us a positive divergence, while the cloud was giving us a signal that we may break, but the RSI, which is also a leading indicator, is telling us what we may see. Right? These are all probabilities. There's no 100% certainty in this. But by adding levels to this and layering it, and then putting yourself in a position where you're looking at leading indicators, while other people are looking at lagging indicators, gives you an edge. It's just a fact. So I hope you found this helpful. This was a very basic understanding of this for beginners. And frankly, this is all for beginners that they need to know. But I think that you should focus on those 2 signals and how those 2 signals can help you and increase your performance. Look at this video on RSI. It's really important to understand that. I would also work on your candlestick patterns, and I would also work on truly grasping this concept, because when you get this concept, it'll take your trading to the next level. So I hope you find that helpful. Everybody trade sharp.